Hey guys, we are live for the Phoenix RIA Redroom, episode number 111. So, if you're jumping on, like, subscribe, whether you're on Facebook, like, comment. If you're on YouTube, like, subscribe, and comment as well. A little bit about the Phoenix market. It is slow as always. As we expect for fall, there's about 25,600 listings. If you've been watching this long enough, we dipped down into the high 23,000s. But as we expect for October and November and December, actually, we get a little seasonality and stuff quits moving as fast. So it's typical. Now, wholesalers will typically start buying maybe mid-November, and are not wholesalers, fix and flippers will start buying more mid to late November, early December, generally buying inventory for that spring market, January market, February market, etc. So as a wholesaler, we're still clipping along pretty well. I know we've sold at least 5 or 6 houses already this week. I see them go through the text on my phone, so we're definitely clipping along pretty good. The 10-year is down still around 4%. It's actually just above 4, 10 basis points above 4. But we're kind of staying around that, that 6%, 6.25% rate for 30-year fixed loans. Obviously, it depends on if you're conventional FHA or VA, what your credit score is, and all that those other factors. But we're still kind of staying around the 10-year, around 4%. As you guys know, the government is shut down, and so we're not getting our jobs reports or any of the economic data that influences the 10-year. Although, like we talked about last week, ADP did pick up and said they're going to start doing weekly reporting on the private sector jobs. So that'll help out. I think that comes out tomorrow. Last week's was a good job report. We'll see what tomorrow's looks like. That's about it on the market. Today we got Domenick on, and I just call him Dom, as you can see. Dom and I go back, I don't know, was it 10, 12, 15 years? I don't actually remember. It's been quite a bit. It's at least 10.
It's at least 10.
It's at least 10.
Well, we went to Pittsburgh together, and that was like 6, 7 years ago, I feel like.
So we actually had some mutual friends, and then we started hanging out at the treadmill together, or not the Stairmaster together.
Don't say treadmill; it's a stairmaster.
Don't say treadmill. We were on the Stairmaster together at 6 a.m. on the Village over at Gainey Ranch, and we like, oh, what do you do? What do you do? Oh, you're a Steelers fan. I'm a Steelers fan, and then it's been match made in heaven ever since. We went to Pittsburgh together 6 or 7 years ago and watched a Steelers game. We've been back. We went back 3 years ago and watched the Steelers game. So anyway, Dom is a business magician. So he had a business pizzeria. I always probably mispronounce Venezia's, right?
Venezia's Pizzeria, yes.
Yeah, I'm not Italian, so I don't know how to say it right.
Most people mess it up. It's not
yeah.
easy.
So and you had 380 employees ish.
Yeah. 380 employees. Yep.
Yeah.
We have 7 locations. Yep.
Yeah. So clearly, Dom's a smart guy to have 380 people working for him, 7 pizzeria locations. He's not just the pizza guy. He's also the McDonald's of the pizza guy. Out of the 7 locations, how many buildings do you own?
I own 4 of them.
Okay, 4 of them. So he's not just the pizza guy. He ended up buying the buildings at some of the places. Anyway, are we allowed to talk about this? That you sold the pizza business?
Yeah, totally fine.
So Dom sold his pizza business, and I'm not going to disclose how much he sold it for, but he's still the CFO at the pizza business. But we were talking last June. He's like,
sold it as an ESOP employee.
ESOP. So that's where you sell it to your employees.
Yes.
Yeah. So Dom and I are talking last, June, he's like, yeah, I think I'm going to go buy another business. I got too much time on my hands. I don't know what to do. And I'm like, well, have you ever thought about just like, because I'm a hard money lender, I always need capital. I'm like, have you ever thought about raising capital? And he's like, his first response is, I'm not a sales guy. Right?
Yep, for sure. I kept saying that to myself.
So, but what I think he's learned is, building a fund isn't necessarily a sales position. It's more of, I think it's just more of being able to dot your I's, cross your T's, and build trust. And what do you think? What's your version now as you?
Yeah, I mean, it's definitely not sales. It's more relationships that I built over the years, and being able to be successful in other businesses and seeing how that went. And it's different for me to like reach out to people that I've known for a very long time and be like, hey, I'm the pizza guy, but there's this opportunity for you, and this equity hard money fund, and it's been great. I mean, everyone just, some of these calls we're on, we're 5 minutes in, they don't even want to go through the entire deck. They just trust what we do. And I think the biggest part is, and what sold me when I was talking to Chris is like, I've been a customer. I've been on the client side with Chris's business since 2018, 2019. So I've seen over the years, they're just very consistent, very, very frugal, make sure that the loans make sense. Never had one issue. The check would always come, 20th of the month. And it's a nice cash flow. It's nice cash flow. So some of these investments you do with apartments, they're 3-4 years down the road. You don't know if you're going to get the pref. There's not a lot of investments you can do where you can get like a quarterly distribution. And that's what I think is easier to sell when it comes to this fund. And I think the other part of that is we talked, and being able to have a fund and then leveraging with the bank relationships I have, that propelled it, because we're able to add like 5 bips plus on top of the return.
Yeah. So just give you a little heads up, kind of little background on what he's talking about. Obviously, I'm a hard money lender, and he was kind of one of the. I generate hard money loans, and I was selling them to Dom, and he had around $800 to $1 million with me, right? So yes. I generate a loan for $250. I'd charge 12% for easy math. I'd sell it to him at 10%, and he's collecting the 10% on his $250, and I'm collecting the 2% spread. And that's basically how I've run my hard money company since like 2008, ever since the financial crisis. So now, when we built this fund, when I'm like, hey, why don't you build a fund and raise capital and go hang out with rich guys and golf with rich guys that want to invest in a fund? He's like, oh. So we explored it. And so kind of step one was just like we actually hired like a mentor, right? Just to get us started.
Yeah. There was a company, we interviewed with several companies, but this particular company, I think they're really good because that's their bread and butter. They advise in funds for hard money funds. And so they basically walked us through the steps and how we should go about it. How should we do the return? How should we talk to investors? And then we spent, a good, I think it was like 6 to 8 weeks kind of figuring out how we want to portray it and how we want to talk to investors about it. And then once we got all of that figured out, and then he actually had a great attorney. They've been phenomenal. They're a bigger firm, but they have like a cookie cutter operating agreement and everything that's pretty. They don't have to do that much work, especially with AI nowadays. So it was a flat rate, and I thought that was very lucrative for us. So we ended up doing that with their attorney, Dorsey Whitney, and then kind of went from there. And then it's just going through SEC, getting approval through the SEC with the Form D, getting that approved, and any state that is investing, whatever people that are investing, whichever state, then you also got to file a Form D, blue sky filings with that state as well.
Yeah. So help me on the numbers. I kind of forget. You have them all on a cool spreadsheet. What did we spend for the coaching on this program? Was it 7, 8, something like that?
15 total.
Huh?
On it was about 15,000 total on the Verivest side. actually 12.5, I think 12.5, 13,000 on the Bear Best side. And then there was about 10,000 ish for the attorney on the attorney side to draft up the legal doc. So in total, you're about 25,000.
Yeah.
To kind of the fund.
And we built a hard money fund, but you can do, Dom's invested in like apartment syndications, and some other funds as well. Not just, the hard money fund. So we specifically did a hard money fund. So our fund docs read like, hey, this is kind of what it is. But how many of the apartment funds have you invested in the past?
I have done about six.
Okay.
6 funds where I'm an LP. I've always wanted to be on the GP side, general partner side, instead of limited partner side. It's just, it's usually they're in this early. They don't want to bring on anyone on the GP side. So you're usually on the LP side. It's just, they give you a pref of like anywhere from 6 to 8% preferred return, paid quarterly. But some of these end up being, we haven't stabilized. It's going to take 6 to 9 months. So it's sometimes tough. So yeah, you definitely got to trust the person that you're, investing with on that fund.
When they say stabilize, does that mean you don't get any pref for that 6 to 9
Yeah,
months?
I usually don't get a pref until they actually stabilize. They get rents to a certain amount, get the occupancy up, because some of these are distressed properties. They're maybe at 65%. They want to get it up to like, 85, 90%. And then they'll start doing the preferred return every quarter after that. And sometimes it could take, a year, year and a half, depends. And some of these funds actually don't actually pay out until there's a liquidation event, which there's one company I'm with that big outfit in Indianapolis, and we invest with them, and it's a 3 to 5 year plan. So you don't see a single dollar until 3 to 5 years.
Gotcha. So not very cash flow, not good for the cash flow. Whereas like the hard money fund is like the money comes in, and I think we took on the first initial open, that's when all kind of the money came in at once, and it took about
we do initial closing. You pick an initial closing where it comes in for that week. You pick a certain date, and then it's an open-ended fund. That's what ours is. So we can continue to bring in money after that. So we have projection models of where we want to be. And obviously, when you can get the raise higher, then your overhead costs don't go up that much after that. So, when you first start, we're looking at it like those costs that we spoke about, they're like 3% of the fund, 2.5%. As soon as we can get to like 5 million or higher, then we can bring it down to 1.5%, and then eventually get it under 1%, which is our goal.
Yeah. So when you were going through once you got past the kind of the coaching program, what do you think the highlights when you were talking to the attorney were? Obviously, we didn't go with hourly; we went with a flat fee. But what do you think were some kind of the highlights that when you're talking to the attorney?
As far as Nick Taylor goes, just kind of learning which way to go about it and giving us advice on whether open-ended or closed-ended fund. And then I think the biggest challenge we had is what percentage we were going to give to the investors and the management. And so we also looked at the management fee, and Chris and I felt that we didn't want to charge a management fee. There's usually a 1% to 2% there. So they advised us, they felt like we should, and we didn't really want to charge that in the beginning, especially with a new fund. So they gave us some advice on that and how we went about it. And then the prep, we were originally going to do like a 9% prep, and then everything. Once you got to 12, after 12, then it was a 75-25 split, being 75% to the LPs and 25% to the management. So those were the type of things we were kind of contemplating and to figure out what was best.
Yeah. So start to finish, I think the first meeting was, early June?
Yeah, I think it was May or June that we started reaching out. It took a good 3-4 months to get the fund operational and ready to go.
Yeah. So $23,000, 4 months, and like you said, if you were a flipper or apartments, and you didn't want to actually get, I call it gap funding and then hard money lending, or you wanted to actually do a fund and fix and flip homes at like a larger scale, you could do this you do this kind of fund and raise $2 to $3 million, and then once again probably go find a decent sized bank that would lend you money on the fix and flip when you're putting decent amount down, you're putting a decent amount of rehab into it. But it might be something for customers that actually just don't want to fix and flip on a smaller scale. They want to do it like a little bit more volume, a little bit more velocity.
Yeah. Yep.
So we did the coaching program, then we got to then we got through the lawyer docs. The next step, which kind of makes our fund interesting, is we're out there funding hard money loans at 12, 13, 14%, depending on the asset class and how much down they're putting and all that kind of stuff. But really kind of where you help the return is then being able to leverage it with the bank. And your bank relationships, definitely with all the buildings that you had bought and the 4 buildings you bought, that's kind of was another piece of the puzzle that you brought that helped kind of, launch.
Yeah, and I think that was challenging just because these banks, especially the traditional banks, they want to hold the collateral. And so they want the property, whereas, obviously we were trying to do it through the capital we raise as the collateral. And so that was a little difficult because traditional banks just don't want to do that. They don't want to take on that risk. The only bank that's kind of in that space is Western Alliance Bank, but they wanted a $20 million raised, and then we could do a 0% recourse. And so that's another thing we should talk about is the recourse. If you get to the 20 million, then there's 0% recourse. You have to sign a personal guarantee, but you got to get to that level, and you got to have these banks that'll trust you until that point. And then, I had a good relationships with a few banks in the Valley, and we were able to get approval through Busey Bank, and very happy for Kevin Halloran to have that trust in us. And we did a 50% recourse. So Chris and I have a 50% personal guarantee on that. And with that being able to do that, we were able to get the rate at SOFR plus 3.5, which, SOFR is 4.2. So we're getting like a 7.7% rate. And if we're lending at, say, 12.9, 13, that's, 5.5, 6%, you can add to your return. So that's been very helpful. So we're going to be finalizing that in a couple weeks.
Yeah. And so, obviously you talk to your banks about hard money lending, and they're kind of a little bit deer in the headlights. If you were talking to a bank about like, hey, I'm going to fix and flip houses, we're just going to take a mortgage out from the bank on each individual asset, like probably a little bit easier for them to, comprehend that one versus like, hey.
And I have that now, I have that currently. I have a business line of credit. They collateralize 2 of my buildings that I have paid off. And I use that money whenever I want. And Chris and I, we've done several fix and flips. And I had a company, AC Buyers Club, for quite a few years with a partner of mine. For about 5 years, we did that as well. But honestly, at the end of the day, doing those returns, you win some, you lose some over the years. And our net return was about 9.5%, 10%. It wasn't.
On the fix and flips.
Yeah. If you pay when you're paying off the line of credit, we had our line of credit was prime plus a quarter, so it was about 7.75, 7.5. Now it's like 7.25. So if you take, we did about 50 homes in about 5 years, and I did the return on all of them, and it's between 9 and 10%.
Yeah.
And we had a lot more risk. So
there you go for some of you fix and flippers that are jumping on and watching. Like, here's a guy that had bank money at 7.75. Basically Dom was doing all the books on the deal, and he had a partner out there doing the acquisitions, doing the rehab, doing the selling. And after paying all the capital, all the rehab, all the closing costs, everything, making 9 or 10%.
Yeah.
So give you an idea, like when people ask me like, well, man, how do you how do people buy your wholesale deals? I'm like, you should only look to be making like 9 or 10%, because that's the reality of the market. It's not like this isn't just like a get rich quick scheme. I watched my fix and flip TV show on HGTV the other day, and we're ready to go be millionaires.
And and you get some home runs, right? I mean,
Yeah.
we definitely had some home runs. We're doubling or,
Yeah.
even 50% return, but there was also a couple dogs in there,
Yeah.
I'm to
We
try and
make
rent it
zero
out
or
for
lose
6
money.
months. Yeah, we lost some money on a couple, and that's what caused it to be in that range,
Yeah. So obviously the bank line, and then that's kind of like, what's funny is I'm not even, I mean, I've lent millions and millions and millions of dollars. And, when you go to, it's a little intimidating, like when you go to these little business banks. And it's funny because, like, I go to these business bank meetings with you, and you kind of like, I want to say push them around a little bit, but you push them around like,
oh, oh yeah. I mean, I called the president and, told him, we've been doing business together for 20 years. Like, the thing is, it's all about relationships. This is the guy head of commercial lending, and it could be the credit officer, the head of credit, and they're the ones just looking at numbers. At the end of the day, you got to look at the person and who they are and what they've accomplished. And I think that's the difference when you find the right bank with the right president. If you talk to the right president, they're the ones that can sign off on it, and they know you're gonna be good for it, especially if I've been doing this stuff with this bank before. So yeah, I think relationships is a big part of it.
Yeah, it was interesting to me because I mean, I borrow money on houses all the time, obviously, do hard money loans, like even soft money loans, raise capital for, doing fix and flips, whatever. But I just don't go deal with like small business banks. And I was kind of under the attitude like he was going to dictate the terms. And you're like, no, 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 no. We don't want a 1 year term. We want a 2 year term.
Yeah, yeah. You got to tell them what you want, and then you kind of go from there. You got to negotiate and get the best deal you can. Because at the end of the day, we got to keep those costs down so we can get the highest return possible.
Yeah.
Yeah.
It was just like it was a little bit of a eye-opening experience for me because I was like, I kind of thought it's the bank, right? They're just going to dictate the terms, and the terms are the terms, and you're like, no.
Well, that's another thing. Like, that's why I have like 3 or 4 banks I deal with, and I know 3 or 4 presidents of the banks. I think it's so important to have the competition, and I think you're going down the line that we kind of need to talk about is like never have one bank when you're in business, no matter what you're doing, because they're just going to shoot you low,
Yeah.
And so when you have competition, it changes things quickly because they know there's another bank willing to do it, and all of a sudden your interest rate comes down, your terms are better, origination fee goes down. All those things happen when you have competition in the marketplace, just like anything.
Yeah. I just think it's like, just different levels. Like, I'm sure people that watch this are probably like, I'm not trying to go get like a $3 to $5 million line from a bank, but just I guess different mindsets when you actually like. Interesting for me. I'm still in the business, and I'm walking to this meeting. I'm like, I was expecting for them to dictate it, and you're like, no, I want it this way.
Yeah.
So I guess you just learn like anything, just like you fix and flip your first house, your first conversation with a banker, like,
The first one you're kind of scared and you're listening to everything they have to say and you don't say much, but when you've been doing it for 25 years or so, you have a different mindset when you go into it.
Yeah.
For sure. Yeah. And I think another thing we need to talk about is like everyone's like looking at taking I get interest rate of 5% and I'm making 5, so why would I ever want to pay this off type of thing. And I think it's important to have a couple buildings or homes so you have that full equity that you can collateralize into other loans. I think that's critical because everyone's just like, oh, I'm not going to pay that off. I'm going to go get another bill. I'm not going to pay that off. And all of a sudden you're leveraged, and having a couple buildings that are paid off or a couple homes that are paid off gives you that opportunity later on down the road to do like a business line of credit and stuff like that so that you have the ability down the road for better situations.
Yeah, for sure. So yeah, leveraging yourself. We jump on this. I repeat this all the time, and it's unfortunate Luke didn't jump on today. Tracy was sick, and Luke obviously couldn't make the meeting. he said he was on the text message, but clearly he's not here. But like, he kind of had all his eggs in one basket at the end in like kind of June of 2022. He was fixing and flipping, and he's like, Chris, I'm making so much money, I can't wholesale. I'm like, well, wholesale helps cash flow, and when you don't have like enough cash flow, and you have a bunch of fix and flips, and then you have the payments on the line of credit and the rehab and all that stuff, and the merry-go-round stops, which it stopped in June of 2022, and you have no cash coming in, or you don't have any, like all your money is out the door, it's a bad situation.
Yeah, then you get desperate and you get taken advantage of.
Yep. Then you got to sell for cheaper and, all the fun stuff. So anyway, we just jump on here for like 30 minutes. What, like someone wanted to say, hey, Dom, I built a fund. Like, I heard you built a fund. What would you like? What are the 3 points that you would say, hey, where do I start? What do I do?
I think first off, you got to make sure you have a great business plan. You have a track record of experience of doing whatever you're going into, whether it's wholesale, fix and flipping, hard money lending. Have that background. You can't just jump into something. And then, I think another thing is having a network of people that that you can trust, I think every relationship that I've had, it's so important for it to be a win-win. I never want to burn bridges. This town's too small. Yeah. So I think it's very important to just have a good group of people that you've had relationships before or done deals with before, so that when you're looking to start a fund and you're looking to raise money, you can go to those people. So that's important. And then the third is, I think you just have to have integrity, you have to have honesty, you have to shoot them straight, and you have to I think the biggest thing with you and I is, like, we're looking at this fund like we have other businesses. This is not our sole income. So we want to give a little back. We want to make sure the LPs are doing really well, so they're going to tell other people and word of mouth. So I think that's the mindset you have to have going into it to be successful. And don't look at it short term. This is a long term situation. So don't look at what your return is in 3 months. Like, I could care less what our GP return is 6 months from now. I'm more looking at right now, making sure the investors are making the best return they can the next 6 months, and then we'll get it later, right? Yeah. So that's kind of, I think, the most important pieces.
And then Don built out a model, and the model, like when you're at 2 million, 3 million, and then even especially year one when you have, call it $23,000 in fees, and then and then you do set up a line with the bank's, what are they, 15, 16 in paperwork for getting the
it's going to be a lot more than that even. Yeah, it's more than that. I think it's we're looking at 30, I think it is.
Yeah.
Total 30 something. Yeah. With the origination fee, the legal docs to have it done, it's like 32. So, but then again, all these costs, you're annualizing it over 2 years.
Yeah.
So it helps the fund. But I mean, that 30,000 is going to be well worth it when you're making 5+ bips on the return.
Yeah. So to his point, like, the GPs aren't going to look at this thing in 6 months, but 5 years down the road, if there's 20, 30, $40 million just rolling around, just clicking away, it can end up being a big deal. So
oh yeah, nice cash cow.
Yeah. Well, Dom, I appreciate you jumping on. This is kind of like I said, friends have built funds, mainly apartments funds, is most of my friends have built. I know a couple of built fix and flip funds, but this was fun just to go through the experience, build a hard money fund with you. And, obviously, I've been doing hard money lending for years. I just never built a fund, but it was a good time. And now that it's up and running and cruising along, it was kind of fun. It was kind of fun to just, do a little recap for people that may actually want to build a fund for themselves or something like that. So
thank you. Thanks for having me. I appreciate it.
Yeah, now we'll go get on the text message and see if the Steelers traded for
Hopefully they got a wide receiver too. Let's see what happens.
Yeah. Anyway, if you watched, once again, comment, subscribe. I'll watch the comments for a few days, and actually it notifies me even if you comment a week down the road. Obviously this stays up on YouTube for a while. So anyway, thanks for joining us. Have a good day.
Thanks. Have a good one.